Hello, everybody, and welcome to the webinar. We're going to give folks just a couple more minutes to trickle in before we begin the presentation. Okay, great. Well, thanks everyone for joining today's webinar about Odyssey's construction credit offerings for solar companies in Nigeria, Kenya, South Africa, Brazil, India, and Mexico. Before I pass it over to Max, who will be presenting today, a couple of quick reminders. We welcome all questions, so please drop them in the Q&A box that you'll see at the bottom of your screen as they pop into your head, and we'll leave time for questions at the end. And also, we are recording this call, and we will send out the recording along with the deck either later today or first thing tomorrow morning. So with that, I'd like to introduce Max, based in Cape Town, South Africa. He is Odyssey's VP of Revenue and has a long track record and career history in the solar industry, working across various facets of the sector. So yeah, without further ado, Max, take it away.
Thank you so much, Elisa. Yeah, it's very happy to be here, and I'm really excited to be hosting today's webinar and tell you more about the latest and the greatest at Odyssey, and more specifically, I guess, our supply chain credit offering. So I think without further ado, let's get straight into it. Just a reminder as well, as Elisa was saying, we'll try to answer all the questions during the Q&A at the end of the session. And if we can't get to it, we'll share an email address with you in the thread, and you can email us directly and we can schedule a follow-up meeting or just engage via email directly. Great. So let's chat briefly about the content of this webinar. We'll tell you more about Odyssey, who we are, and the work we're doing across the various geographies we operate. We'll chat about pain point experience by developers. I think these pain points are shared across the globe, and I'm sure they'll be very relevant to you. And then we'll essentially discuss how our construction credit facility, our supply chain credit facility, addresses this pain point. We'll dive deeper into a business case, looking at cash flow implication of running a project and how our credit facility can essentially address these cash flow constraints. And lastly, we'll get into how you can apply for the facility and what that process looks like. Great. So let's start by chatting about Odyssey. So who is Odyssey? Odyssey is the largest finance and tech platform operating across the value chain of the DRE ecosystem. So what it means is that we really operate on the entirety of the value chain. We deal with all its players, and we like to say that we are working on this value chain, not necessarily in it. And we play the role of enablers. We like to think of ourselves as enablers. So depending on what role you're playing yourself and the different transactions you're engaging with, we plug ourselves in between this transaction so that you can essentially have more of them and increase the velocity of this transaction overall. How do we do that? I mean, it's a big statement to be the largest ecosystem supporting the DRE ecosystem. There's a number of ways, or number of products we have, a number of engagement we have across the value chain to enable this transaction. And I guess the main players are the financiers, the equipment manufacturers, and solar companies or energy companies, broadly speaking. So with financiers, we essentially support them with a software that we have dedicated to streamline the process they need to go through in order to deploy capital into the sector. These financiers could be large DFI or commercial financiers. Essentially, our software enable them to dilute the risk associated with disbursing capital into the sector, increase the overall visibility, as well as streamline their workflows so that due diligence can be the due diligence timeline, could be shortened, and you can essentially deploy capital in a much quicker way, safer way, with an increased visibility. With solar companies, we support you with a procurement platform that we offer across the globe or across our geographies, with credit embedded into it. And that's what we're going to focus on today, is what we call supply chain credit. Lastly, with equipment manufacturer, because of the scale of our operation and the network of developers that we have, we are able to aggregate procurement across the globe and negotiate what we call the most favored nation partnership with these OEMs, which essentially give us better terms, better pricing, which we can then give back to the energy companies we work with. So that's in a nutshell the work we do across the value chain. Yeah, let's move forward and chat further about our supply chain credit offering. So a few words about our operations. As you can see on this slide, we're truly a global company. So we have operations in South Africa, in Nigeria, in Kenya, India, and more recently in Brazil and Mexico. Bear in mind that the product we offer does have some nuances across the globe. So the principle of what we're going to address today is true across all these geographies, but there may be some product specificities and nuances that may be specific to a country and not to another. So I'll try to stay as generic as possible today. And if you happen to be in one of these geographies, then we can engage after this webinar or in the Q&A about specific questions for each of these countries. Few numbers about Odyssey. As I mentioned, we are an ecosystem. And today we've got, I think we're closer to 3,000 platform members using our platform to do business. So these members could be equipment manufacturers, they could be developers, they could be financiers running electrification programs with the platform. They could be anyone using our procurement platform to access these better terms. We've got I would say, a very diverse ecosystem that you can tap into depending on what you're trying to achieve, and always with the intent of making doing business easier for you. So 3,000 platform members, we've got $2 billion of capital available to deploy. So to be clear, this is not Odyssey's equity, this is capital we're deploying on behalf of large financiers. And the vast majority, admittedly, of this $2 billion comes from large DFIs. To date, we have facilitated the deployment of 2.3 million solar systems across the globe. So it's not 2.3 million systems that we have financed necessarily. It's 2.3 million systems that either we've monitored, that we may have played a role in the procurement phase or run the tender program. So that's just to give you some kind of understanding of the scale of our operation and how extensive the work we do is across the value chain. And lastly, we run 43 financing programs. So these financing programs are essentially, to give you an example, we work very closely with the World Bank, where we support them in deploying concessional capital dedicated to electrifying Africa. One very famous one that some of our Nigerian fellows may be aware of is the DES program in Nigeria, with whom we've been involved for some time already. But these are the financing program I'm referring to. These are concessional and commercial financing programs. Okay, so let's unpack our construction credit offering. So just so that you understand, when we speak about construction credit, we speak about supply chain credit. Supply chain credit being the umbrella term we use, and then construction credit being one of the products sitting under the supply chain credit offering we take to the market. So let's go back to the very beginning, highlighting the pain points that developers face in running their operations. And these pain points, again, are true across the globe. And the first one is working capital management. I think as a solar company, in order to scale and to be successful as a business, you need to be able to manage your cash flows accordingly. So you're constantly balancing your inflows and your outflows of cash. And if you can't do that accordingly, you won't be able to be sustainable as a business, nor will you be able to grow. So the very first pain point we're addressing here is working capital. The second one is, and I guess is in line with the first pain point, is the misalignment that there is between the credit line you have access to and your project cash flows. As a solar company, you're constantly looking for a source of capital in order to kickstart procurement, and try to align your credit obligations with the inflows of cash you would get by completing project or achieving construction milestone on site. And this misalignment is true whether you are using the credit line from local suppliers, from overseas manufacturers of equipment, or even using traditional lenders' credit lines. So what ends up happening is that Odyssey, solar companies, end up having to essentially bootstrap everything themselves, over time build cash reserves, and with these cash reserves, scale the operation, build more projects to essentially build larger projects and increase revenue. The third pain point we're addressing today is, or we want to unpack today, is your inability to borrow from traditional lenders. And it's true, and I think we have to admit it, that EPCs and aggregators or developers, however you want to call yourself, are services companies. So you have a fairly small balance sheet. Unless you have an asset core on the side that you can leverage in order to raise capital, the reality is that it's very difficult for a developer to raise capital with a bank or a traditional lender. And if you manage to do so, the process to access capital is very lengthy and full of paperwork. And lastly, again, in line with the pain point number 3, is that the number of alternatives available out there is very limited. It's true all across our geographies, and that's why we've decided to take this offering to the market. So let's unpack this supply chain credit offering, and more specifically the two products we're taking to the market. These two products are designed specifically for developers. But if you are a distributor or an equipment manufacturer and you happen to be on this webinar, bear in mind that we have a dedicated product offering designed for your operation. So it may not be called product procurement credit or construction credit, but essentially it's the same principle. It's bridge financing procurement, whether you're doing it for your client or for your own procurement activities. Let's start with procurement credit. And one way to define procurement credit is to take a practical example. You have a project in Africa somewhere, and you need to procure 5 megawatts of solar module from a Chinese manufacturer. You could essentially use a signature facility if you've got one, or you may have maxed it out already, and therefore you're going to have to use your cash. And generally speaking, you would be expected to pay 60% of that transaction value upfront in order to kickstart the order, and essentially pay the balance with this equipment is delivered and cleared in country. Which means if you spend $10 million on a single transaction, you're going to have to spend $6 million upfront that will be locked in a single transaction for 3, 4, 5, 6 months, the time for the OEM to manufacture your order, ship it, clear it in country, and only then you can access it, and then you have to pay the balance. So it's very cash flow intensive, and it's a pain point. It's a major pain point for many of you. So if you have that cash up front to do so dedicated to procurement, then it's great. But many of us actually don't have access to this capital to log this transaction. And you are forced to charge your customers larger deposit up front in order to kickstart procurement. So this procurement credit offering is designed to essentially remove the cash flow constraint associated with the procurement of large orders from overseas manufacturer. The way it works is that we would essentially charge you an upfront deposit of, let's say, 15% to kickstart the transaction with the OEM, and we pay the OEM in full. With that procurement credit offering, we have a fully fledged procurement department who would ship and clear the goods in country and bring it into our warehouse. From there on, you would receive what we call an IDN, which is an invoice on delivery note, that gives you a pre-approved amount of time to come and collect the goods. As you want to come and collect the good, only then you are expected to pay us the balance of 85% of the order value. The price you're receiving from us is obviously the price of the product. Let's chat about equipment price. Could be the same one as you've pre-negotiated with your OEM, or even better. As I mentioned earlier on, we have most favored nation partnerships with a lot of very famous brands around the globe, so we might be able to achieve better pricing. So the benefits of that product are A, you free your cash flow constraint associated with this large order, and B, you may be able to achieve cost savings for the procurement of your equipment. That's procurement credit. The due diligence around this product and how you access this, we're going to get it later on in this webinar. The second product we're going to chat about today is construction credit. It is structured exactly the same way as procurement credit, but gives you the ability to settle the credit facility later on during construction. So just like procurement credit, you would pay a small deposit up front. We pay the supplier in full, whether that supplier is a local distributor or an overseas OEM, give you the ability to come and collect your equipment and then build your plant. And only once you collect payment from your own customer, we expect to get paid ourselves. This facility is truly designed to address cash flow constraints, number one, experienced during the delivery of this project, but also to address the mismatch between existing credit line and project receivable that we discussed earlier on on the previous slide. So that's in essence what supply chain credit is all about. It's really a credit offering embedded into a procurement platform dedicated to remove the cash flow constraint associated with procurement. The main difference between these two products is the time at which you are expected to pay for the balance of the credit offering we've given you. So what makes our supply chain credit unique? So number one, it's an industry-specific credit facility designed by industry experts for the industry. At Odyssey, we are all former developers, former bankers, used to work within DFIs, engineers. So we really come from the sector. So our ability to identify the risk associated with this project is improved, and therefore our ability to manage the risk is also improved. So as we design this credit offering, it is designed specifically for the sector. We don't get involved in other sectors other than the renewable energy one, and that's because that's all we know. That's where we're coming from, and the pain point we're addressing are very specific to your industry and the work you do. Number two, it's on-demand short-term credit dedicated to equipment procurement. There's a lot in this sentence. On-demand, purely because by the time you apply for the facility, within 5 working days, you can have access to it, and we can start procuring for you. Short-term, purely because it's dedicated to cover the working capital gap experienced during the procurement and construction phase. We could go all the way up until 12 months or COD, whichever comes first. And we'll get back into these terms and how we expect it to get paid back. And again, dedicated to the procurement of equipment, purely because we're not traditional lenders in the way that we will give you a cash facility and lend you money for you to go procure. What all we do is procuring on your behalf and give you extended payment terms than what you would be getting if you were buying directly from the same supplier or the same manufacturer. Number 3, settlement schedule that align with when you get paid. Again, as I mentioned a few times already, your cash flow constraints are now a thing of the past, purely because your credit obligations starts when you get paid only, not before that. And lastly, we will have to believe that we have the industry most competitive rates, considering the fact that this facility is completely off balance sheet, it's unsecured, it can be accessed on the fly, it's on demand really, and these rates are digestible. We know that EPCs often are forced to absorb a lot of the risk. That's the mandate of an EPC essentially. If it was easy to develop and build renewable energy system, EPCs would not exist, and we all know it's not. And we understand that the margin associated with a lot of these projects are very thin. So we want our fees to be digestible and to be in line with the general economics of the business cases you service on a daily basis. Let's chat further about the terms of the facility. So again, these terms vary from one region to the next. I just want to reiterate that. So if you have, again, a project at hand that you're looking for finance and you really need to get moving quickly, get in touch after this webinar. We'll schedule a call and we'll be able to get into the details of the facility within your country. But generally across the globe, the ticket size or the envelope size of the facility we're able to deploy is anywhere up to 3 to 5 million US, depending on where you are. The credit period we are willing to cover goes all the way up to 12 months. So from the time we're paying a supplier, we can give you up to 12 months to pay us back. Again, I just want to reiterate that it's 12 months or COD. We're getting a lot of requests from developers that want to provide credit term post-COD to their customer on the back of this facility, and we cannot do that. Our credit offering is only deployed against secured project financing. So as you have your project financing secured, whether it is a bank financing for financing the project, an IPP, an asset co, or even a cash deal, we need to ensure that there's somebody else on the other end that has the capital available to take us out of the facility, and we need to get paid at the latest when the project is being handed over to your customer. So it's up to 12 months or COD, whichever happened the soonest. The deposits we require are generally between 15 and 50%. You're probably wondering why 50% and why 15. Generally speaking, we work on 15% purely because that's one way of de-risking the transaction. It's one of the security. Because our facility is completely off balance sheet, we also want our EPC partner to have skin in the game. It's another incentive to settle the facility. Purely because if you don't collect the equipment or don't pay for the entirety of the facility, you forfeit the equipment remains ours, and you forfeit your 15% deposit. That's the first reason. The second one is that some of the equipment we would procure on your behalf have a very low resellability threshold or a high risk profile. So if we increase the deposit, it's just one way of mitigating the risk associated with the project. The cost of the facility. So generally speaking, it sits between 1 to 2% upfront on the lendable amount of the facility, and then 1 to 2% per month. Let's just reiterate that. So it's 1 to 2% upfront on the amount you'd be borrowing from us, not the amount of the purchase order, and then 1.2% on 1.22%, sorry, on the outstanding amount that you owe us. So it works on a sliding scale. If you are an EPC that focuses on C&I project, very often you get paid per milestones on site, and we'll get into it in a second. But as you achieve this milestone, you'll be paying back a section of the facility. So your cost of capital, your cost of credit associated to the principal debt or the value of the credit we're providing you with is a lot less than 1.2% per month because it works on a sliding scale. What type of security do we ask for? Depending on the country you're in, again, we've got a lot of different mechanisms. But generally speaking, we need to have a security mechanism in place that enables us to collect the payment at the source. So as you get paid, we need to get paid first. A lot of you will have different debt obligation with traditional lenders, which are on balance sheet, as we all know. So the way we look at this is that we want to ensure that as you collect payment for the project that we've been providing credit for, we are the first one to get paid. Again, a lot of different ways of doing this. You could open a shared account. We can have an escrow contract associated with an existing account that you own, which is your pays account. There are lots of ways to do it. And because, again, it's so diverse and differs vastly depending on where you run your business, we can address these different types of securities offline after this webinar. The repayment of the facility, again, depends. If you are a Nigerian developer who is building mini grids under the DAS program, you only get paid on commissioning, and therefore we would expect to get paid on a bullet payment at the end of the project once the project is commissioned. If you are a C&I developer, we collect milestone payment from your customers, then we will align our repayment schedule with these milestone payments. As I mentioned again earlier, the approval time to get access to this facility is 7 to 10 days. The reality is that we've done it in a much shorter time period. It's just depending on volume and resources available. We just manage expectation by giving a 7 to 10 days lead time. That for construction credit. If we had to look at a procurement credit, the due diligence process is a lot thinner, and therefore we don't. We can give you some feedback and approval much quicker than construction credit. Okay, so with all of this in mind, we will essentially answer a question later on, but let's chat further about why is the construction credit facility unique. So first, it's on-demand credit matching your cash flow variability. As I mentioned multiple times already, we want you to be able to access our credit facility on the fly or on demand. We understand that EPC business is a very transactional business. You need to be able to move quickly. By the time you are being appointed for a project, you generally have 2 months to plan, procure, complete your engineering plan, and access the capital you need to build the system. And that's why we've made this credit facility accessible on demand. It's off balance sheet, so it's not additive to the other facilities you may have with your bank or with distributors or anyone providing you with credit, purely because we're not actually providing you with capital. It doesn't appear on your balance sheet. The equipment remains on ours until the facility is fully paid for. We provide you with flexible repayment schedule. I think we've said this a few times already today. We want to give you feedback essentially within 5 to 7 working days, as I mentioned earlier. We're not asking for any surety or personal guarantees from the business owners. And lastly, our rates and terms are super attractive compared to the equivalent in the industry or what traditional lenders will provide you with. I expect a few questions already around fees and comments on the fact that we are more expensive than banks. What we've seen is that a lot of very established EPC and developers will have bank facilities, and you'd have pre-approved terms to it. You have an upfront processing fee per year, and then you're paying a monthly fee on it. And if you can use this facility, use it as much as you can. You want to be able to use cheaper capital first if you have access to cheaper capital. But as you want to increase the size of this facility, or if you maxed out this bank facility, come and see us, because we add that level of agility to your activity. And again, the way we operate is that you can truly increase the size of the facility or the size of I would say, the pre-approved envelope you have with us as your business grows and as your business needs change with the seasons throughout the year. Okay, so let's unpack the cost of this facility. I'm just painting the picture here of a very typical C&I project. Essentially, it will take you 2 months, 2 years to develop a project. We'll know that as an EPC, most of the time, the project development phase is done at risk. Then you would be appointed. As you get appointed, the vast majority of us will charge an upfront deposit. Although we've seen a lot of projects these days that don't even get paid deposit, but the first milestone would be on delivery of equipment to site. And then as you achieve your milestones, or as you move on during project deliveries, you'll collect payment from your customers. So the top section of this slide is essentially your project timeline and the inflows associated with this timeline. At the bottom is essentially our facility and how does it compare to your inflows of cash. So the bottom would be your outflows, because that's what you have to pay us back, and at the top is essentially what you're collecting from your customers as you build this project. So a typical repayment schedule, here we're using just a practical case. So we're looking at a shipment value in US dollar of roughly south of 800,000 US. The deposit we would ask you is 15% of the total order value, which would be 114,000 US. We would be lending you the lending amount here is essentially the shipment value minus the deposit received, 650,000 US dollar. The terms we're providing you is 6 months, purely because that's, in this case, that's the time it would take you to build that project and achieve practical completion. The processing cost of this facility was 1.5%, and the monthly cost is 1.5%. So you can see, starting in 1st of January and completing the project by the end of June this year, you would essentially receive, or we would procure for 650,000 USD of equipment on your behalf on the 1st of January, and that processing fee cost is appearing right there. So a few months later, which let's assume that you've achieved your first milestone, you collect 50% from your own customers. we would be expected to have 50% of this facility settled. So you would pay 50% of the principal debt, 325,000 US, and the interest accrued during that period. So the 19,500 here is essentially 650,000 times 1.5% times 2, because it's over 2 months. And we collect the first milestones. Now, 2 months later, you achieve another milestone. It could be commissioning of the plant. Then we would collect 25%, because that's the milestone associated with this sorry, that's the ratio associated with these milestones. And you can see that the cost of the facility decreased vastly, purely because now you're only paying interest on the balance of the credit facility we've deployed for you. So you're paying 1.5% over 2 months of 325,000 US dollar, and so on until practical completion and that your project is built. So if you had to work out the total cost of our facility for this project, the total cost of the facility here is 6.75%, because it works on a sliding scale. So it's just important to put these fees into context, because you don't calculate our fees by calculating the number of months, by the monthly fee, by the size of the facility. It's really on the sliding scale that we operate, and therefore, for your benefits, it's much cheaper than what it seems like at first glance. Here we're looking at a typical, I would say, cash flow tracker on a 30 days terms. You're procuring from local distributors or from an OEM who will give you 30 days terms. So after 30 days from the day of invoice, you would have to cover your facility. It's exactly the same project. It's a 1.5 million US dollar project. Equipment cost is 1.2 million. Here again, we're comparing inflows of cash with your outflows of cash. The milestones in terms of inflows are exactly the same as the one of the previous slide. And you can see 30 days later, regardless of the state of your project, you have to fulfill your credit obligation with your supplier. So what is the net result on your cash flow? The net result is that 3 months out of the 6 months of the construction phase, you're running cash flows negatively. So you have to essentially achieve more milestones on site and complete them in order to flow to cash flows again. Here's just a visual illustration of your cash flow curve, of a single project cash flow curve, which is what you want to avoid. The orange line is your cumulative inflow, the blue line, cumulative outflows. And as you can see, this is the zero axis at the center. The first 3 months, this yellow line is running below zero. And that's fine. I think it's the nature of the business to have some project running on a negative cash flow. You may use your cash credit facility with your bank or the overdraft available. But if you're running 5 to 10 projects concurrently with negative cash flow, unfortunately, this curve will become your business cash flow curve. And we all know the potential result it could have. So now we're looking at exactly the same project using our construction credit facility. So as we've discussed already, I won't get into the details of this table, but you essentially floating your cash flows by aligning your outflows with your inflows. And this is how your cash flow curve will look like. Cumulative inflows at the top, cumulative outflows at the back, at the bottom, sorry. And you'll see that your net cash flow remain above zero. And that's obviously what you would want to do across a portfolio of projects you're building. But we all know that it's not easy. And that's why you're constantly juggling between deposit payment from your customers, different credit facilities you may have access to, and so on. Okay, so let's understand better our process and what needs to happen. Should you have a project at stake today, get in touch with us and we'll be able to support you. The very first step that we generally go through is that we pre-qualify. As I mentioned, we have different strategy and different ways of operating across our geographies. I'll give you an example. South Africa is mostly focused on C&I project. So is Kenya and India. In Nigeria at the moment, we're only working on the back of the DS program. So we would have to see a grant agreement in order to be able to deploy a facility. It may change from next year onwards, but we need to pre-qualify you depending on the nature of your project and the nature of the project finance you have in place. So if you have a project that falls within the criteria I just mentioned, please get in touch with us. Number two, the second step is to take a view on your company. So once you're pre-qualified, we'll onboard you on our platform, on our ecosystem, where you'll have to share your company audited financial statement, your management account, a company brochure. It's generally quite light in terms of the document we require, but it's purely for us to get a sense of the financial health of your organization, number one, and number two, to get a feel for the experience that you have. If you're applying for a credit facility to build a 7 MW hybrid system, but you've only built 50 kilowatt peak system grid tied, it's likely that we won't finance the transaction. So we want to align experience with actual project that you're applying credit for. Once you're onboarded, on the other hand, you're on our system. So it's a one-off step. You've got your permanent file created, and then it's just a matter of submitting project details in order to get access to our credit offering, which is step number 3. So as soon as you're onboarded and we've got your permanent file completed, we'll take a view on individual projects, which is essentially, again, very light due diligence. We want to see your BOM, understanding, take a view on your cost. We want to look at your contract. So we will need essentially a signed contract. We need to ensure that there's somebody else on the other hand who will be buying the system and taking us out of the credit facility, but also understand your payment terms. So we'll compare your cost, your BOM, the different POs you have with your suppliers, with your contract receivable, and we'll align the two. And then we'll submit a quotation, which is step number 4. That quotation is essentially our only contract. As we mentioned earlier, it's very low on paperwork. This quotation is a 2-page quotation. The first page being the numbers, and the second page the T&Cs. No hidden fees, no hidden terms. It's essentially very easy to action, but also very easy to understand from a commercial standpoint. There's no fancy terms or any unnecessary complications. By the time you've reviewed the quotation, the way to accept this quotation is essentially to pay the deposit. On the day you pay the deposit, we'll procure with your supplier. So we'll pay your supplier in full, whether it's sitting in your country where the project is or overseas from a large manufacturer, and we'll kickstart the transaction. By the time the transaction is live and the payment is made to a supplier, you can track the status of this transaction on our platform, whether it's being manufactured, if it's sitting in transit on the ocean, if it's sitting at customs. We add a very strong layer of transparency for you to keep an eye on your equipment or where it sits, and if there are any delays within the procurement phase of this product. And you can track all of that directly from your profile on the platform, as I mentioned. Step number 5, we deliver the equipment, whether we deliver equipment on site or at our warehouse, depending on the credit offering we'd be using, if it's procurement credit or construction credit. If it's construction credit, you collect your equipment, you move forward with the construction of your plant. We collect milestone payments or bullet on completion, and on the last payment, we'll issue an invoice. Transfer of ownership of the equipment gets transferred onto you, the EPC or the developer, as the invoice is fully settled, and the transaction is closed. And the way we've been working across our region is really to start with a single transaction with a partner, to build confidence on both sides, for everyone to get familiar with each other's process and the way we operate. And then once the first transaction goes through, then it's very easy, because we just need to gather project details, your BOM, your POs, your suppliers. We already know you, we know your business, we've got a view on your financials and your experience, so we can deploy and procure for you on a recurring basis, and it's extremely easy and streamlined. I won't get too deep onto it. This section is meant to address the process on our platform and how do you apply for the facility, but it's, generally speaking, quite self-explanatory. And if you have any question, there's a live chat on the platform. You'll get immediate support as you go through that process. And that's about it, I believe, for today. We can move into Q&A. I don't know if there are any questions. I guess none. Let me see in the chat. We've got a hand raise. Ryan, I believe you raised your hand.
Yes, I'm muted. Yes, so I just wanted to ask the question specifically around, is this potentially a tool that can be used, let's say, as a developer EPC, where you're taking control of the construction, effectively like the construction finance, taking the project all the way through to commissioning, and then effectively you can, instead of working with, let's say, a fund that does the progress payments for you, we can come to Odyssey now, go through that whole process, and then sell the project at the end of. So if, let's say, if we get an agreement with a fund that says, upon reaching commissioning, we will purchase the thing if it meets this IRR or this or this or this or this, and then we is that what the intention of this is? Because I think that's a great solution.
Yeah, I'm so glad you're pointing this out. That's one way to use it. You can generally increase the commercial appeal of your proposal, whether you're selling to a fund or to an end user. And instead of collecting a payment milestone during delivery, you could move the bulk of the payment at the end. And generally, it's a lot more appealing. Like a fund funds don't like to disburse and to take construction risk. So you could essentially tell them just pay us when the site is live and operational, and we essentially fill that gap during the construction phase. So yes, it can definitely be used this way.
Maybe could I ask a follow-up question on that?
Yeah, please. Absolutely.
Okay, so specifically, I mean, the scenario I'm thinking of is, because oftentimes you get two different parties. You have a developer and then you have a EPC. Now, does this cater for the scenario where you have a separate developer, separate EPC? The developers will be taking some of the risk, and then maybe the developers developing the client, getting all of those things, the EPCs fulfilling some of the technical roles. Is there a way to bundle that in? And who is taking you can say, doing the credit application in that case?
So we've done it both ways. So I'll give you an example where we've worked with developers, and other example where we've worked with the EPCs. So we worked in scenarios where the developer is sitting overseas. He's got a project somewhere in Africa. He's currently relying on the EPC to procure and have to pay the EPC construction milestones in order for the EPC to procure. With developers, what we've done is essentially enable the developer or the IPP, however you want to call them, to remove the procurement mandate from an EPC, to dilute the risk on the EPC side, and essentially enable the fund to disburse later during delivery. And we've also seen it the other way around, where the EPC, as a developer, on the other hand, the developer or an IPP, and the developer is not willing to pay the milestone associated with the project. Let's say it's an hybrid project with a fairly high upfront capital requirement. Then essentially what you could do as an EPC is lower your first milestone payment. We procure for you. So it can work really both ways, and every single transaction is quite different, but we're very flexible in the way we can structure it. I hope it answers your question.
100%. Thank you very much.
Thanks, Ryan. Next question came from Abu Bakr.
Okay, good morning, Eon. Can you hear me?
Hello, yes, we can.
Okay, yeah, I did before yesterday. I was able to attend another webinar, advancing distributed project with artists.
Yes, yes. I think Justin was running the webinar. Yes.
There was a complaint I tried to lay about, the process of this, your application. I did my application over 3 months ago, but no response. I got. Laid my complaint on that webinar, but nothing has been done. So I think this your process is not as seamless as it seems to be explained. I think there is a need for you to look at our applications and look back into it. I don't know what makes one to, seamlessly get pre-qualified.
Abu Bakr, I'm sorry, the line is really bad, and there's quite a bit of noise in the background. I think I know exactly what you're referring to, and I believe it was flagged during the ATES webinar earlier this week. And we've got Damola in Nigeria, one of our account manager, which we should be engaging you if it hasn't been done before the end of business today. So if there's been some delays, there must be some underlying reason. I can't tell you exactly now which one they are. We apologize for it, obviously, but let's take this offline. I think if you've applied and you qualify for the project, there's no reason not to proceed. So if that's okay with you, we can discuss it offline, and Damola from our Nigerian team will engage with you directly.
Okay, can I have the contact of Damola so that I can be able to reach out to him in case if you cannot be able to resolve my issue today?
Sure. It sounds urgent, so we'll definitely put you in touch with Damola today. Thank you, Babakar. Any other questions from the attendees? Busuma, I believe you've raised your hand. Busuma, you're muted.
Okay. Can you hear me now?
Yes, nice and clear.
Oh, great. Yeah, so I just wanted to find out. I'm from Zambia.
Okay.
I saw the places where you have your operations. I wanted to find out if you also can reach us here.
So the short answer is that at the moment, our core focus are Nigeria, South Africa, and Kenya. With that being said, one way we could make it work is if we could escrow the funds, because we don't have an entity in Zambia, to be completely honest with you, while we have one in all the other countries I mentioned earlier. If you're developing a project which is being funded by an international fund, there might be room for us to get involved. When we don't have an entity, it's slightly more complex for us to be able to support. Zambia, at the moment, we don't have a plan this year in 2024 to open an entity there, but this may change next year. What I'd like to suggest, Busuma, is for us to chat offline again, get an understanding of your project. And again, if the funds are coming from overseas or your supply, if you're being, for instance, if your supplier is sitting in South Africa or one of our other country, we may be able to credit on the supplier side and de-risk ourselves with the supplier directly. But there is some complexity and nuances that are that we would need to discuss together. So the short answer is I don't want to say no. Let's discuss further after this webinar.
Okay, great, thanks.
Thank you, Busuma. Any other question from our attendees? Good. Well, thank you, everybody. Thank you for joining us today. It's been a pleasure presenting. I hope we can get in touch very soon. Thanks, Ryan. Thanks, Abubakar. Thanks, Busuma, for your questions. Abubakar will ensure to get in touch with you before the end of business today so we can get into the weeds of this transaction and the problem you've raised. But yes, thank you, everyone, and we hope to see you very soon.